Are you tired of the endless 9 to 5 grind, feeling like you're stuck in a rat race with no finish line in sight? Imagine a future where you're no longer controlled by your alarm clock because your money is working harder for you than you are for your money. This isn't just a daydream, it's an achievable reality. Today, we're not just going to talk about escaping it. We're going to lay out a detailed, surprisingly simple blueprint for building a life of true financial freedom. This single investment could fundamentally change your financial future. An investment so simple yet so powerful that it has earned the unwavering endorsement of the most successful investor in history. What if you could own a piece of Apple, Microsoft, Amazon, Google, and hundreds of other dominant American companies, all with a single click? It might sound too good to be true, but it's not. We're going to take a deep, detailed dive into the Vanguard S&P 500 ETF, ticker symbol VOO. By the end of this video, you will understand exactly what VOO is, why it is arguably one of the best investments for the vast majority of people, and how you can use it to build a multi-million-dollar portfolio for your retirement. We'll break down the specific advantages with hard data. We'll explore why legendary investor Warren Buffett champions this exact strategy. And we'll run the numbers to show you the incredible potential of investing just a few $100s a month over time. This isn't about a get-rich-quick scheme. It's about a proven, time-tested path to wealth. So, let's get into it. First, let's break down what VOO actually is. VOO is an ETF, which stands for Exchange Traded Fund. The simplest way to think of an ETF is as a basket that holds a collection of different investments, in this case, stocks. When you buy one share of VOO, you are buying a tiny sliver of every single stock in that basket. It trades on a stock exchange just like a regular stock, like Apple or Tesla, meaning you can buy and sell it throughout the day. The specific basket of stocks that VOO holds is designed to track a very important benchmark, the S&P 500 index. The S&P 500, or Standard & Poor's 500, represents 500 of the largest and most established publicly traded companies in the United States. These are household names, the titans of industry. Think about the companies that dominate our daily lives: the iPhone in your pocket, the software on your computer, the online store you order from the credit card you use. Chances are, they are in the S&P 500. It's a market capitalization weighted index, which is a fancy way of saying that the bigger the company, the larger its share of the index. So, giants like Microsoft and Apple have a much larger impact on the performance of VOO than the 500th company in the index. This means you are most heavily invested in the biggest and most successful players in the American economy. By buying VOO, you are essentially making a bet on the long-term growth, innovation, and profitability of corporate America as a whole. It is the ultimate passive investment strategy. Instead of trying to find the needle in the haystack by picking individual winning stocks, you are simply buying the entire haystack. And as we'll see, that haystack has performed remarkably well over time. Now, let's break down the 4 pillars that make VOO such a compelling and powerful investment. The first, and perhaps most crucial pillar, is radical diversification. The old adage, "Don't put all your eggs in one basket," is the cornerstone of sound investing, and VOO embodies this principle perfectly. If you were to buy stock in a single company, your entire investment's fate is tied to that one company's success or failure. If it soars, you do great. But if it faces a scandal, gets outcompeted, or goes bankrupt, you could lose everything. We've seen it happen to giants like Enron and Lehman Brothers. With a single share of VOO, you instantly own a piece of 500 different companies. This spreads your risk out enormously. But the diversification goes deeper than just the number of companies. These 500 companies operate across all major sectors of the economy: information technology, healthcare, financials, consumer discretionary, communication services, industrials, and more. So, if the tech sector is having a tough year, perhaps the healthcare or energy sectors are doing well, providing a buffer for your portfolio. This built-in diversification smooths out your returns and protects you from the catastrophic failure of any single company or industry. It's a safety net that is nearly impossible for an individual investor to replicate on their own without significant capital and effort. The second pillar, and this is a game changer, is the tyranny of low costs. Fees are a silent killer of investment returns. They are a small leak that can sink a great ship over time. Many actively managed mutual funds, where a manager is paid to pick stocks, charge an expense ratio of 0.5%, 1%, or even more. An expense ratio is the annual fee you pay as a percentage of your investment. VOO's expense ratio, as of today, is a minuscule 0.03%. Let's put that into concrete numbers. If you have $10,000 invested, a 1% expense ratio would cost you $100 every single year. With VOO's 0.03% expense ratio, that same $10,000 investment costs you just $3 per year. Now, you might think a 1% difference is no big deal. But let's see the destructive power of that difference over a long investment horizon. Imagine you invest $100,000 and let it grow for 30 years, earning an average annual return of 10%. In the high-fee fund charging 1%, your effective return is 9%. After 30 years, your $100,000 would grow to approximately $1.32 million. Not bad at all, but with VOO, your effective return is 9.97%. That same $100,000 invested in VOO would grow to approximately $1.73 million. That seemingly tiny 1% difference in fees cost you over $400,000 in wealth. It is the single biggest yet most overlooked factor in long-term investing success. Vanguard, the company behind VOO, is structured to be owned by its funds, and by extension, its investors. This unique structure allows them to keep costs at rock-bottom levels, passing the savings directly to you. The third pillar is its proven historical performance. While it's crucial to remember that past performance does not guarantee future results, the long-term track record of the S&P 500 is incredibly compelling. Since its inception in 1926, the S&P 500 has delivered an average annual return of approximately 10% to 12%. Of course, this journey is not a straight line up. There are years of negative returns, like in 2008 during the financial crisis, or more recently, in 2022. But historically, every single bear market has been followed by a bull market that has pushed the index to new all-time highs. By investing in VOO, you are harnessing the power of American capitalism, innovation, and economic growth. You are betting that the brightest minds at the world's leading companies will continue to find ways to grow and create value, a bet that has paid off handsomely for a century. The fourth and final pillar is tax efficiency. This is a more subtle but still significant benefit. Because VOO is a passively managed index fund, it has very low turnover. Turnover refers to how often the assets within the fund are bought and sold. Actively managed funds are constantly trading, trying to find the next big winner. Every time they sell a stock for a profit, they generate a capital gain, and those gains must be distributed to the shareholders. That's you, who then have to pay taxes on them, even if you never sold a single share of the fund yourself. VOO, on the other hand, only sells a stock when it's dropped from the S&P 500 index, which happens infrequently. This low turnover means fewer capital gains distributions, which in turn means a lower tax bill for you each year. This allows more of your money to stay invested and compounding, further boosting your long-term returns. Now, if you're still skeptical, let's bring in the ultimate authority on investing. Warren Buffett, the Oracle of Omaha and CEO of Berkshire Hathaway. For decades, Buffett has been one of the world's most successful stock pickers, building a legendary reputation for his investment prowess. Yet, when asked what the average person should do with their money, his advice is consistently simple and clear: buy a low-cost S&P 500 index fund. He has famously stated, "In my view, for most people, the best thing to do is to own the S&P 500 index fund." He doesn't just say this, he's put his money where his mouth is. The most powerful evidence of his conviction is a famous 10-year bet he made starting in 2008. Buffett wagered $1 million that a simple, unmanaged S&P 500 index fund would outperform a hand-picked selection of hedge funds over a decade after fees. Hedge funds are managed by supposed financial gurus who charge exorbitant fees for their expertise. The result? It wasn't even close. Buffett's chosen S&P 500 index fund delivered an average annual return that was about 5% higher than the actively managed collection of sophisticated hedge funds. The so-called smart money was thoroughly beaten by a simple, passive strategy available to anyone. Even more personally, in his will, Buffett has instructed the trustee managing the inheritance for his wife to put 90% of the money in a very low-cost S&P 500 index fund. He specifically mentioned Vanguard in his shareholder letter. This is the ultimate endorsement. The greatest investor of all time, with all the knowledge and resources in the world, has determined that this simple strategy is the safest and most effective way to secure his own family's financial future. He understands that costs and broad market exposure are the winning formula for the long run, and that trying to outsmart the market is a fool's errand for most. So now we get to the most exciting part. Let's crunch the numbers and see how a consistent investment in VOO can transform your financial life. For these projections, we'll use a 10% average annual return, which is right in line with the S&P 500's long-term historical average. The key ingredients here are consistency and time. Let's start with an investment of $250 per month. Over a 20-year period, you would have personally invested a total of $60,000. At a 10% average annual return, your portfolio could grow to be worth approximately $190,000. That means over $130,000 of your portfolio would be pure growth from the market. Now let's extend that to 30 years. Your total contribution would be $90,000. Your portfolio's value could balloon to an incredible $569,000. Notice how the growth accelerated dramatically in that third decade. That's the magic of compounding in action. And if you stay consistent for 40 years, your total investment of $120,000 could transform into a nest egg worth over $1.58 million. You would have become a millionaire by diligently saving just $250 a month. Let's double that and see what happens if you can manage to invest $500 per month. After 20 years, your total investment of $120,000 could grow to approximately $380,000. After 30 years, your total investment of $180,000 could be worth a staggering $1.13 million. You'd be a millionaire in 3 decades. And after 40 years, your total contribution of $240,000 could result in a massive portfolio worth over $3.16 million. Finally, let's look at a more aggressive savings plan of $750 per month. In 20 years, your $180,000 in contributions could be worth over $500,000 at approximately $570,000. In 30 years, your $270,000 investment could grow into a life-changing $1.7 million. And after a 40-year career of saving and investing, your total contribution of $360,000 could build a legacy portfolio worth a jaw-dropping $4.74 million. These numbers are not fantasy. They are the mathematical result of consistent investment in a powerful economic engine, fueled by the power of compound growth. The money you invest earns returns, and then those returns themselves start earning returns, creating a snowball effect that can lead to exponential wealth over time. This leads us directly to the ultimate goal: retirement and potentially early retirement. The numbers we just discussed are not just abstract figures, they represent freedom. The freedom to stop working because you can, and to start living life entirely on your own terms. A popular guideline in the financial independence community is the 4% rule. This is a rule of thumb that suggests you can safely withdraw 4% of your portfolio's value in your first year of retirement, and then adjust that amount for inflation each subsequent year, with a very high probability of your money lasting for 30 years or more. Let's apply this to our new examples. If you built that $1.58 million portfolio by investing $250 a month, the 4% rule suggests you could withdraw over $63,000 per year to live on, without ever having to work again. If you reach the $3.16 million mark by investing $500 a month, that translates to a retirement income of over $126,000 per year. And with the $4.74 million portfolio, you're looking at an annual income of nearly $190,000. For most people, this level of passive income would provide an incredibly comfortable, if not luxurious, retirement. This strategy is the financial backbone of the FIRE movement. Financial independence. Retire early. By saving aggressively and investing wisely in a vehicle like VOO, you can dramatically shorten your working career. Of course, no investment is entirely without risk. VOO is comprised of stocks, and the stock market is volatile. Its value will go up and down. There will be scary headlines and market crashes. It is an undeniable fact that you will experience periods where your portfolio's value declines. The key is to possess the emotional fortitude to stay the course. The biggest risk for a long-term VOO investor is not the market itself, but their own reaction to it. Selling in a panic during a downturn is how you lock in losses and destroy your long-term plan. History has shown us that these downturns are not permanent. They are, for the disciplined investor, incredible buying opportunities. In conclusion, the Vanguard S&P 500 ETF, VOO, represents a pinnacle of modern investing strategy for the average person. It provides instant and wide diversification across the American economy. It does so at an almost unbelievably low cost, ensuring that fees don't erode your wealth. It harnesses the historically proven, long-term growth engine of the stock market. And it comes with the unequivocal endorsement of the world's most respected investor. The path to building significant wealth is not complex. It does not require you to be a financial genius or to take wild risks. It requires discipline, patience, and a simple, effective plan. Start today. It doesn't matter if it's $50 or $500. The most important thing is to start, and to let the power of time and compounding do the heavy lifting for you.